From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
All right, 30 minutes into the U.S. trading day, Thursday, July 14th. Busy day. Here are the top market stories. Banks, the bad and the ugly. Morgan Stanley's investment banking revenue slumps. J.P. Morgan halts buybacks. Jamie Dimon sees a serious set of issues clouding the economic outlook. We're going to dig through those numbers. And claims creep up. Initial jobless claims hitting the highest since November. Producer prices topping 11%. Investors look at that softer growth and persistent inflation. We're going to speak to Federal Reserve Governor Christopher Waller. And B of A warns on recession. The bank now sees a recession this year, a 25% decline in equities, and a 10-year yield at 2.75%. We're going to speak to B of A's head of U.S. rate strategy, Mark Cabana, about that rate call. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like there's a push and pull. Here in the U.S., we have inflation, earnings, strong dollar, curve inversion. And then over where you are, you're looking at a political crisis now unfolding in Europe. And those two really playing out in many ways in the FX market.
Yeah, they're playing out with a significantly weaker euro. We are now firmly below one. Parity is in the past tense. We have moved beyond that. We've got banks to think about as well over here. How will this impact the banking sector? I think is something to think about too when you look at what is going on here. But it all starts with the gas story, as we've just been discussing. That's where the story is going to evolve next week into the ECB. But the ECB's got a whole range of problems. But as you say, the Fed has got its own problems as well. It needs to be thinking about. It needs to be thinking about what it's going to do. Is it going to hike 100 basis points? Are we going to get that full 1%? You pile on top of that what is happening in the banking sector as well. Fascinating to see the results kicking off in this way, isn't it? You've got J.P. Morgan down, I think it's down 3-4%. Morgan Stanley's down around 3% right now. J.P. Morgan, of course, we now know, temporarily suspending its share buybacks. Now, part of that's regulatory, but the bank did report second quarter results that fell short of estimates. It's also turning up the heat on the scrutinizing of the lending book. Now, this is what the company's CFO, he of course is Jeremy Barnum, talked about on that issue on the earnings call.
Obviously, in this moment, we're going to scrutinize even more aggressively than we always do elements of our lending which are either low returning or have a low client nexus or both. We do that all the time anyway, but of course, in this moment, we're going to turn up the heat on that a little bit.
So that brings us to our question of the day. What is the bottom line for the banks? And what is the bottom line for the economy from the banks? Let's try and address both of those two questions, because I think they're both germane here. Wall Street correspondent Sonali Basak joining us to give us a take on the banking side of the equation. From a macro point of view, we're joined by Bloomberg Markets editor Christine Aquino. But Sonali, let me start with you. You've had time to digest all of this. What's the bottom line? What's the takeaway?
Yeah, there was a lot of expectation about the banks making so much more money off of net interest income in the coming year. And now that expectation, Guy, it's already baked in. So how do the banks make money above and beyond that? The idea here that trading revenue was a little weaker than expected at J.P. Morgan in the fixed income business, a behemoth business with a ton of volatility, is a bit concerning to some investors. And then you have Morgan Stanley as well, where the second half of the year becomes a lot blurrier in terms of what performance will look like, even though they beat this time around. Investment banking has not only declined at all of the major business lines so far, we also saw JP Morgan take a significant multi-hundreds of millions of dollars worth of a hit when it came to its bridge loan business. These are risky buyout loans often. They're loans to riskier corporate borrowers. And, you know, when you take a look at the pain you're seeing on the consumer side potentially, as well as what you're seeing on the corporate side, you have kind of a double-edged sword there.
Yeah, and I also feel like what's important is what their loan books are doing. Now it was about releases last year, and now it's about builds. Christine, part of that feels like it's par for the course, but did we learn anything about the economy through the money they're putting aside for any kind of soured loans?
Yeah, it's very interesting, Alix, that they are making these sorts of preparations now, and even just hearing from Jamie Dimon in his assessment of the broader macroeconomic environment, he is very aware of all the risks that are on the horizon. There's, of course, the potential slowdown that will be the effect of just the massive tightening that the Federal Reserve is going to have to do now, especially after that blowout CPI number. And then, of course, how how that's going to impact businesses as well, especially as we're heading into earnings season. Of course, we're going to start hearing more complaints from companies potentially about the impact, for instance, of a stronger dollar on their earnings outlooks. And so all of this combined really just tells you, these banks are gearing up for a potential recessionary environment in the near future. It's very interesting that they're doing that now, even at this stage when, Jamie Dimon is maintaining that the consumer looks good at this point in time, but that doesn't necessarily mean that that's going to be the case 6 months forward.
Shonali, James Gorman talking about how volatile the trading environment is right now. When I think about how to value a bank, and I think about banks like his, and maybe like Goldman Sachs as well, that are so reliant on trading and what happens on Wall Street, their Wall Street-focused banks, do they need to be marked down in terms of their valuation? If volatility is going up, presumably there is a risk of something going wrong. How do you think the market will be perceiving what Mr. Gorman had to say?
It's an interesting question, Guy, because we talk about this a lot. Value at risk. No one likes to talk about it. The banks are so-called safer since the financial crisis, but that risk is going higher, and the buy side is burned. We know this. There are so many funds out there that are suffering steep losses. And guess what? On top of that, the cost of leverage, borrowing money to put back into markets, is going up. It would be interesting to hear. The call is still going on right now, and to hear the CFO and CEO speak to Wall Street about whether prime balances are holding up at this point in time. And that's just the corporate side of the equation. To the point you guys have been making is, what about the consumer? Morgan Stanley's customers tend to be high net worth individuals here, but they are hoarding a lot of cash. And, sitting on cash doesn't make the market go anywhere, as you know.
Shonali, we've also seen the leveraged loan market, some really recent pain there. And I'm wondering if the banks have fully reflected or been hit by the recent turmoil. We're also seeing credit spreads for junk bonds really start to widen out here. Is that reflected yet in the numbers? And have they said anything about what their outlook might be?
And thank you for asking that, because JP Morgan did take a very large hit in that side of the business. But they also said that their hit was not as bad as what you're going to see in the rest of the industry. They kind of hinted at the idea that there would be more pain elsewhere. And by the way, the reason that's so interesting now is that you do have a lot of folks, not just on the buy side, in private equity, in corporate America, that is saying the banks are sitting on their hands a little bit right now. When you talk to JP Morgan about it, what they're saying to investors is some of this is because of capital requirements. But remember, now you do have a new update from Morgan Stanley as well, where they do see some sort of recession ahead. James Gorman says that's unlikely to be deep and drastic, is what he says. But it is likely to hit the U.S. and it is likely to hit Europe much harder. And again, these are global banks. It's really important to look at the global footprint as they're lending.
Christine, we're spending a lot of time talking about what rate hikes are doing and how the shape of the curve is affecting the banking sector. But alongside that, we're also now into the territory of seeing QT, which at its most basic level, and I really do simplify here, is money destruction. Are we starting to see within some of these bank numbers, evidence that financial conditions are tightening, evidence that QT is having an effect?
Absolutely, Guy. I mean, I think, some of the numbers that we're already seeing now, that net interest income, that was meant to be the hopeful side for banks when it comes to this tighter monetary policy environment, right? You have the adage that higher interest rates usually are a good thing for banks, but the fact that they're not necessarily able to capitalize on that as well. And then on the other hand, again, that demand destruction, that money destruction that you're talking about, Guy, we're very much starting to see that flow through now, just in the decrease in lending activity and some deterioration in some of those more consumer-focused metrics. It really is telling the story again of the idea that with this runaway inflation that we're currently seeing now, the response that the Federal Reserve will have to do in order to respond to that will again precipitate that recessionary environment, perhaps as soon as next year. And you can really see that it's two tales of the same sort of story here, really, for the banking numbers that we're seeing now. It'll be interesting to see how that develops. And I think the key question moving forward is, will banks be able to capitalize on the market volatility that we're still likely to have as the markets chew through this process while staying as recession-proof as possible?
Shonali, last question for me. Tomorrow we get six banks reporting here. Any of them riskier here? Do they take on more risk that we're going to have to see them pare back or put more money aside for bad loans?
It's not even just the idea that they could put more money away for bad loans. I think you also have to watch charge-offs. How much are those loans converting into bad loans? If you look at what's happening at JP Morgan, even before we saw the print today, Jamie Dimon did guide that this could be in the billions in a year. And so is it Bank of America changing their expectations that more customers will not be able to finance their obligations if they get into a tougher economic scenario? Right now, they are still spending on discretionary and non-discretionary purchases, but does that also start to change? I think Bank of America will be a big tell on where the consumer really stands.
Sonali, great stuff. Thank you very much indeed. Bloomberg, Sonali Basak, Christina Kino, thank you very much indeed for setting the show very, very nicely. We'll continue with the conversation surrounding the banks in just a moment. I want to update you on what is happening out of the UK. We're getting the latest round of voting in the race to succeed Boris Johnson. Basically, what you need to know is that Rishi Sunak and Penny Mordaunt are basically cementing their lead at the front of the race. Suella Braverman has now exited the race. We are whittling down the candidates. We will whittle them down to two, remember, and then those two candidates will go in front of the wider Conservative Party, Alix. But Sunak and Mordaunt basically leading the pack right now.
And just for the market update there, cable rate, 117 is where we sit as that dollar continues to climb higher. All right, coming up, we're going to get a shareholder's take on those bank results. Adams Fund CEO Mark Stokel owns some of the names. He's going to join us next for his take. This is Bloomberg.
Earnings season is coming.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross currents.
Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
It's the first real indication you're seeing of both CEO confession season, right? Actually really looking at what the true impact of the earnings season that we've been kind of refusing to acknowledge in keeping these estimates high. And also the real impact, the first look at the real impact on what's happening with consumers, the real effects of inflation and financial conditionings tightening at the warp speed that they've been tightening is going to show up in earnings. There's no place to hide on this.
That was Daryl Cronk, Wells Fargo Wealth and Investment Management CIO, earlier on Bloomberg Television. You have markets really off here, S&P up by about 2 full percentage points. Let's get back to the question of the day. What's the bottom line for banks? And what's the read-through for the economy and the rest of earnings season? We're joined now by Mark Stokel, Adams Fund CEO. He's underweight JP Morgan and overweight Bank of America and Wells Fargo in his portfolio. Mark, it's always great to see you and get your perspective. Looking through some of the numbers, some of the things that the banks highlighted, what's your biggest takeaway so far? What's the bottom line?
I think the bottom line is it could have been worse, but it wasn't so bad. I think, looking at JP Morgan, a couple of good things about it. One is they did flow through some net interest income. We need to see a little bit more of that. I think that was good. Capital got better. But I also think with JP Morgan, and it's been talked about a lot, the pause in the stock buyback was telegraphed a long time ago. I don't want to conflate that with some new concern about the economy. I mean, in the call, Jamie Dimon talked actually pretty glowingly about the consumer, pretty glowingly about business, how it's going. I think his position is he is anticipating that something could go wrong, as opposed to forecasting that something is going to go wrong.
Okay. Given all of that, and given the track record of what the banks have delivered thus far this year, I still take a step back from what I've just seen from these banks, and it's only Morgan Stanley and JPM so far, but that's a pretty big slice. And I'm thinking, Mark, why do I get excited? How could I get excited about this banking sector? It has come down pretty far so far, but I didn't see anything here that gets me excited, that makes me think, you know what, these are businesses that are thriving.
Well, they certainly aren't thriving, and I would agree with you, Guy. I think that there isn't anything that in the short term that would say, I got to be in these. I need to be in these. But if you're a longer term investor, again, I'm not calling this the bottom, but I think it's pretty close. And so depending on your time horizon, JP Morgan is doing a lot of good things. We expect that Bank of America will on Monday will report good things. Morgan Stanley wasn't so bad. So if you believe that your portfolio is advantaged by having bank exposure. Is this a time to begin to go into them? I think you could argue that, but certainly, Guy, you're absolutely right. There's nothing that would get you excited about this. And again, a lot of it really revolves around uncertainty. We don't know with the hot number we got the other day. We don't know what the Fed's going to do in 13 days. We don't know what the balance of the earnings season is going to give us. We don't know whether they'll have a special meeting, and the Fed will have a special meeting in August because things are so, there's so many uncertain things here, which to me means if you're a trader, I would be really careful. If you're an investor, it's not a bad time to begin with an eye toward filling out a position over the next 3 or 4 months.
Hey, Mark, so where would that be? So I know you're underweight JP Morgan, but to your point, it's at a 52-week low. It's trading at, 9.4 times estimated price to earnings ratio. So it's really cheap. Is that where you want to be? Is it tech? Is it cyclicals? Like what's already priced in for, say, a 100 basis point hike from the Fed? Or is that a big risk now for the market that you need to be protecting yourself against?
I think you need to protect yourself a little bit, but I do think that depending on how quickly the Fed ends up raising, and who knows whether the 75 in 13 days becomes 100 and whether they do something in August and then whatever September is. But I think as a longer term investor, you need to understand that at some point growth is going to become dear. And so completely ignoring technology or healthcare, some of these other things that are growing, I think a long-term investor does at their own peril. So I think you need to be balanced. I've always talked to you and Guy about that. I think you need to be diversified and balanced. I think student body left or student body right is not the right thing to do here. So should you have some exposure with JP Morgan or Bank of America or we have Wells as well, or Morgan Stanley, I think there's an argument to be made. But don't overlook a little further down the road, if the Fed does what they hope to do, growth is going to become more scarce. And then you want to really make sure you're not completely out of technology as an example.
Just to come back to the banks, if we could, for a moment, Mark. When I look at what is happening on Wall Street, when I look at the uncertainty you've just laid out, when I think about the volatility we've already seen and what is potentially to come, are these banks safe enough? What is the potential for a mistake hitting one of these institutions during this volatility? They obviously have insulated themselves in a completely different way than they were going into 2007, 2008, 2009. But the kind of volatility we're seeing right now, is that going to cause a problem? Should I be thinking about revaluing some of these businesses on a lower multiple because of the risk that we see, particularly on Wall Street?
I don't think so, Guy. I think that when you look at CCAR and all of the tests that have been done, I mean, we talk about it every time these results come out of the stress tests, and the stress tests are almost silly in how difficult they are. So I really do think that the banks are in from a capital standpoint, the businesses that they're in, the way they look at risk, I think they're in really, really good shape. Frankly, the issue here is, the old adage, you do not want to own financials if we're going into a recession. Now, I don't know about you and Alix, but I have no idea whether we're going into recession. It seems like it's a more likely scenario, but then how deep is it? And what kind of a recession is it? I mean, let's think about this. We don't think it would be a consumer recession because the consumer is still in good shape. Jamie Dimon talked glowingly about the consumer. We don't think it's going to be a credit issue because the banks right now, we've seen it. Credit is pristine. And Jamie Dimon this morning talked about his credit card portfolio being prime. So I don't think it's going to be that. Could it be industrial, commercial, industrial? It could be. But I think as it relates to the risk you're talking about, Guy, I think that is not a high risk at all as it relates to the banks.
Mark, that was a really good answer to that question. And I'm wondering, the dollar seems to also be the big question mark here. Really strong, curve inverting, a 5-month, a 30-year inverting again for the last time since June. The 210 continues to invert. What signals are you looking for that's going to help you answer that question?
Well, historically, the inversion that you talked about, whether it's the 2, the 3, the 5, the 7 to the 10, they're all inverted. And historically, that has meant a recession. Now, is it possible that we get a recession? It's certainly possible. We just don't see it being that deep. And again, there are a lot of things that backstop that. The consumer, again, everybody's waiting for the consumer to be bad. Hasn't shown up yet. Doesn't mean it's not going to, but really hasn't shown up yet. And I think that, again, credit is really good around the economy. There's a lot of cash. So I think if we are going into a recession, we're going into this recession in probably the best position we've been in any recession I can remember. So could it be shallow? We think if we go into recession, it is likely to be shallow. But certainly the everything to the 10-year is flashing that the recession is coming.
Yep.
Proof is going to be in the pudding.
Yep. As you say, there's a lot of uncertainty. Very difficult to judge exactly what the granularity is going to look like. Mark, always a pleasure to catch up. Thank you so much for your time. Mark Stokel, Adams Fund CEO. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Amazon has moved a step closer to settling 2 European Union antitrust investigations. The cases have to do with how the e-commerce giant uses rival sales data and whether it unfairly favors its own products. The European Commission is now asking Amazon competitors for feedback on a proposed settlement. Amazon says it's engaging constructively with the EC. And a dispute has erupted between London's Heathrow Airport and one of the biggest airlines in the Middle East. Emirates has rejected Heathrow's demands to cut capacity and says it will operate flights as planned. The carrier flies 6 Airbus A380 Super Jumbos to Heathrow every day. Emirates says Heathrow isn't giving it enough time to rebook travellers onto other flights. And that is your latest business flash. Guy, Alex.
So Tim Clark taking a fairly belligerent tone, but I guess he hasn't been given much warning. It's going to be interesting to see whether others follow suit, Alex. I'm going to be talking to Qatar Air in a couple of days' time, get their perspective on this. Actually, airlines are trading higher today, and the reason they're doing so is that oil prices are coming down, and that's starting to feed through. So you've got names like Ryanair having a fairly good day here in Europe. But yeah, I think this Heathrow story's got legs. That's going to be a big fight.
Especially then when you come up with the demand destruction at the same time, maybe in the fall. I don't know. Doesn't look good. All right, coming up, Bank of America cutting its 10-year yield forecast. We're going to speak to the man behind that cut, Mark Cabana, next. This is Bloomberg. We're an hour into the U.S. trading session. It is an ugly day with lots of things happening across all different asset classes. Bloomberg's Abigail Doolittle is tracking some of those moves for us. Abigail?
Yeah, Alex, it certainly is an ugly day. Lots of red on this screen and cross asset class, as you were just mentioning. That S&P 500 off of its lows, at the lows down more than 2%, but nonetheless, over the last 5 days, down 5 days in a row. That's the longest losing streak since mid-June, and the worst losing streak, I think, down about 4% or so over that time period. The NASDAQ 100 down about the same amount. So investors really not liking what they're seeing in terms of all of the uncertainty about inflation in particular and big banks, which we'll be getting to in a minute, but making the recession call to some degree. Could be oil down 3.9%, similar to the S&P 500 off of its lows, but breaking critical support. And take a look at that euro below parity, really pretty amazing for the first time since 2002, highlighting some of the issues in Europe. Relative to oil, let's check in on a chart that we've looked at before. And the idea here is that massive move that we saw up earlier this year, not sustainable. It's taken a while to come down, but here clearly is the oil coming below generic, below its 200-day moving average. This entire area of consolidation up here is likely, not definitely, but likely to break down toward support at, let's call it, somewhere below 70. So should that happen, it would certainly support the idea of less demand. I was reading yesterday that Americans are using less gas right now because of the high prices relative to 2020 at this time. That's the degree of demand coming off. As for the big banks, lots of weakness here. And of course, JP Morgan putting up a pretty bad quarter, missing basically everything but sales, down 3.7% off of its lows. But those reserves increasing for bad loans, suspending the buyback Traders not liking it. Morgan Stanley well off of its lows, down 0.8%, missing investment banking estimates. And then Wells Fargo and Citi, they're up tomorrow. Let's see what they bring. And then finally, perhaps the biggest culprit here, Guy, with rates rising. We are not looking at rates here, but they are higher in the day. The Bloomberg Dollar Index hitting an all-time high. Now, this goes back about 20 years or so. The DXY not at its all-time high. But this area of consolidation, it is modestly bearish. So it's going to be very interesting to see. Either way, this area of consolidation will either break way up or to the downside. It goes a little bit to the bears, but whenever you see patches of trading ranges like that, it's not the range that counts, Guy, it's the way it breaks. So we're going to see another big move in the dollar head. It's going to be very interesting to see which way it goes.
Absolutely. We are definitely watching that story over here in Europe. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle. Let's continue the conversation around what's happening with the macro picture. The Cleveland Fed President, Loretta Mester, making it clear that the latest inflation report means that policymakers are going to have to take another look. She spoke to Bloomberg TV.
Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
Joining us now to discuss what happens next and where ultimately the Fed goes. Bank of America Global Head of U.S. Rate Strategy. He, of course, is Mark Cabana. Bank of America just made a substantial downward revision to its rate forecast. Mark, walk us through that revision and why.
Sure. You're right. We did make a substantial revision. We took down our 10-year forecast from the end of this year at 3.5% to now 2.75. And we also took down our 10-year forecast for the end of next year from 325 to 250. Why? Well, it has a lot to do with the revised call from our U.S. economists. They're now expecting a recession in 2022, so this year. And according to the quarterly GDP numbers, they think we're going to be negative each quarter this year. So we're pretty much in a recession already. And with that, they think that the Fed's hiking cycle will be limited. They see the terminal rate at 3.5%. And importantly, we're now baking in interest rate cuts from the Fed in the second half of next year and in the first half of 2024. So with that trajectory, a slowing economy, inflation that finally peaks and begins to moderate, a rising unemployment rate, and a Fed that's going to cut, you got to take down your rate forecasts, and that's exactly what we did.
Hey, Mark, what did you do with your 2-year? And that's basically my way of asking what happens to the curve over this scenario that you laid out.
Yeah, so we've long forecasted a 25 basis point 2s, 10s inversion. The market's there right now. It obviously got there very quickly over the last couple of trading days with the elevated inflation print. And we've kept it at 25 basis points. But given how elevated inflation is, the risks are that the curve can get more inverted, not less. The Fed has to continue hiking aggressively. We can debate 75 or 100. The market's thinking more 100 than 75 at this point in time. And with that, it's no surprise that the curve should invert. Because the Fed will be putting monetary policy in restrictive territory, and that's going to slow the economy. It's going to increase the unemployment rate, and it's ultimately going to result in the Fed needing to lower rates. But that's probably a year or so into the future.
Just out of curiosity, Mark, where do you sit on the 7,500 debate right now? You say it's something that everybody's watching. What are your thoughts?
The House view is still 75, but goodness, have the risks shifted. And if you're the Fed, you have to ask yourself, why not? If the market's giving us this option, why should we not take it? And even if the Fed hikes 100, the top of the Fed funds target range will still be 2.75%. That is not in restrictive territory, according to how all Fed officials are thinking about the long run dot. They've thought about 3% or above as being restrictive. And so even if you hike 100, you're still not, according to everybody on the committee, in restrictive territory. So if the market's giving you the option, why not take it? Certainly the risks are skewing in that direction. And look, I know the Fed has provided guidance saying that the next move will be 50 or 75. But ahead of the June meeting, they also told us that 75 was not on really the table. And that's what they ended up delivering. So the market is somewhat skeptical of the Fed's forward guidance. And the market is certainly pricing in elevated probability of a 100 basis point hike at this meeting. In just a few minutes, we're going to hear from Fed Governor Waller. He's someone that we are going to be paying especially close attention to for his guidance on the 75 versus 100 debate. And again, he's been traditionally hawkish, and we think that he will probably come out and certainly not try and tamp down market expectations for 100. We think that's going to be a pretty good signal that the Fed is leaning in that direction if the communications do evolve that way in just a little while.
All right, Mark, let's just say that they can, and they do 100 in July. What then happens in September and the rest of the year? How quickly can they get to restrictive territory? It doesn't feel like they can get to 4% at this point.
Yeah, the market's no longer thinking that they'll get to 4%. I mean, they certainly can if they want to. They can keep going 100 at each meeting for the rest of the year, but that seems like a very low probability at this point in time. The question is going to be, how does the data evolve? And the Fed has told us time and time again that they will be data dependent. We believe that they're data dependent today. Again, you've got a bad CPI report yesterday, so that increases the odds that they go more aggressively in the future. And then they're going to be watching to see how other economic indicators evolve. And look, there are some signs that the economy is slowing. Certainly, you saw a small uptick in claims today. That may presage a broader slowdown in the labor market. You're seeing oil and other commodities come off to some extent. That's going to reduce inflationary pressures to some extent. And we're also seeing a pretty meaningful deterioration in consumer and business sentiment, along with consumer spending. We really see that clearly in the B of A credit card data. We think we're going to see a pretty big miss on retail sales tomorrow, consistent with that. And if the data does indeed slow along these lines, then the Fed can dial back. And come September, they can do 50, they could do 25, they could do 75, depending upon how the data comes in. But certainly, they're going to have a lot more flexibility in the trajectory once they get to around 3%. And we do expect that they will ultimately slow things down.
Mark, are we sure that a mild recession is going to be enough to fully eradicate inflation from the U.S. economy?
That is the biggest question I would say we have on the macro outlook. Is a mild recession going to be enough? Right now, our economists pencil in increase in the unemployment rate that's just 1 percentage point. So it's from 3.6 to 4.6. And we think that will be enough to slow inflation, moderate the economy, and bring inflation down. But the real risk is that inflation remains more persistent, and you might need to see a larger increase in the unemployment rate. Either way, the Fed's going to be slowing the economy down. We believe there are clear signs of that today. There's been a material loss of momentum in the U.S. economic outlook, and we do think that the Fed will be successful at slowing the economy. The real question is just how much slowing will it take to get inflation to moderate? Right now, we're in the mild recession camp, and we certainly hope we stay that way.
If I ask the opposite question, Mark, is there a way that inflation actually comes down a lot faster? And just take a look at oil, for example, WTI below its 200-day moving average. What weight of possibility do you put on that? It's sort of the opposite question from Guy. What happens if we actually get inflation moving down much faster than we think?
Then the Fed is going to, I think, have no problem dialing things back quite materially. And then, ideally pausing perhaps sooner than the market anticipates, and maybe holding their cutting rates a little bit sooner than the market may anticipate as well. I think that this is a problem that the Fed would really like to have. It's just that when you look at the underlying components of that CPI report, it just seems like things are trending in the wrong direction for the Fed. Owner's equivalent rent, the single most important component of CPI, is accelerating, not slowing down. Also, on the good side, you're seeing apparel, household furnishings, used cars. They appear to be re-accelerating to some extent. And so if you're the Fed, you can't really be too worried about what happens on the backside of this as inflation falls, because right now, inflation is continuing to move against you, and it's continuing to surprise to the high side. So I think the Fed would very much like to have that problem. If it does happen, I think they'd be very happy to take back some of the cuts that the market is currently priced and not remain in restrictive territory for as long. But right now, that's not the issue that they face.
It's like that soft landing runway, getting smaller and smaller. Hey, Mark, it's really great to get your perspective. We appreciate you joining us on your call. 10-year yield forecast now for the end of the year at 2.75%. Mark Cabana, Bank of America, head of U.S. rates strategy. And you just heard him tease it for us. Chris Waller will be speaking at 11, and then Michael McKee will do a Q&A with the Fed governor. As Mark was saying, he's hawkish. We'll be looking for how he talks about 100 basis points. Coming up right now on this program, though, a new study is showing that the cost of living crisis is going to hit women the worst. We're going to talk about the World Economic Forum's report with managing director Zahida Zahidi. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Fred Hochberg, the former chairman and president of the Export-Import Bank of the U.S., joining Bloomberg Television 12 noon New York time. This is Bloomberg.
Well, we just saw prices paid by U.S. consumers roaring to a fresh 4-decade high. The ripple implications there were huge. The World Economic Forum is out with its latest global gender gap report, and in that it talks about this deepening cost of living crisis, saying it's also likely to impact women more than men as women continue to earn and accumulate wealth at lower levels. Let's get more into this. Joining us now, Zahadia Zahidi, World Economic Forum Managing Director. Zahadia, thank you for joining us. Walk us through your findings as we sort of manage this high inflation, strong dollar story right now.
Okay, so first we're looking at how well countries are performing overall. And at the very top of the rankings, there's Iceland, which has closed about 90% of its gender gap. At the very bottom, Afghanistan, about 44%. But overall, if we take the trends of the past and project them out into the future, it's going to take 132 years to get to gender parity. And what that means in today's economy is that we won't have the right kind of creativity and ideas, and in the midst of this cost of living crisis, women are going to be suffering more than men.
Sadia, we have a labour shortage around the world. Many women have left the labour force and they have not come back. Is there a connection that you can draw between those countries that are doing well and those countries that are doing less well in terms of the tightness of their labour market? If I'm doing well and I have both genders fully engaged in the labour force, is my labour market looking better?
Absolutely. The countries that have made it easier for women and men to be able to combine their family responsibilities with their drive in the workforce and have made it possible to have that balance, those countries are doing better. So Scandinavian countries are doing better, and they have put in place the kind of care infrastructure and the kind of workplace policies that allow for that to happen. In many other parts of the world, in most cases, men are spending less than a third of the time on unpaid work responsibilities that women are, and that basically means we all have 24 hours in a day and women are starting to drop out. And that, of course, has major long-term implications. It means households are saving less. It means there's less income available to invest in the future generations. So there's a lot of long-term repercussions beyond what's happening at this moment in time.
So, Zahadia, you talked about it in terms of the corporations that are having the right kind of policies. And I'm wondering, where are we in terms of governments having the right kind of policies? If everyone's kind of hit with this rising cost of living increase at the same time, they just don't have enough workers. Everybody's in need of people. How do they get them into the office?
So, you know, there's one silver lining in all of this, and that is when we look at leadership levels. So just before the pandemic, there were about 33% women in leadership positions. That has gone up to approximately 36%. So some kind of leadership or senior position shakeup does seem to have taken place. That's a relatively fast change over the last couple of years, but that is only going to be sustainable if more is done on the overall environment in a company. So is there the right kind of pipeline in place? Are companies reaching back into colleges and schools to get the right kind of motivation, the right kind of talent in? And are they providing the right environment to have balance in the workplace and ensure that there's equal opportunities for progression and promotion? That's on the company side. And on the government side, it is really all about the care infrastructure.
Okay, well, let's talk about care. Anything with a high labour force participation is currently going up. Inflation. Labour is getting more expensive. That means that childcare is getting more expensive. Is this problem only going to get worse?
It is likely to if certain governments don't invest in a care infrastructure. And they really need to think of this as an investment in the same way that we think of physical infrastructure as an investment. If you invest in the care sector, the education sector, the health sector, not only does that solve a lot of problems for families and allow people to be able to flourish in the labor force, but it's also a massive job creator. And so that will also, again, address a lot of other needs across most economies.
Sadia, thank you very much indeed for bringing us the report. Sadia Zahidi, World Economic Forum Managing Director. Thank you very much indeed. What have we got coming up for you next? President Biden still in Israel. He flies to Saudi tomorrow. He's going to meet with the Crown Prince. We're going to have a live report from Jerusalem on what we should expect. This is Bloomberg.
My views on Khashoggi have been absolutely, positively clear. The reason I'm going to Saudi Arabia, though, is much broader, is to promote U.S. interest. Promote U.S. interest in a way that I think we have an opportunity to reassert what I think we've made a mistake of walking away from, our influence in the Middle East.
That was President Biden earlier at a press conference in Jerusalem talking about his upcoming meeting with the Saudi Crown Prince. Joining us now, Bloomberg's Anne-Marie Hordern joining us from Jerusalem. Anne-Marie, did we get anything today that we need to pay attention to, and kind of what are we looking at over the next 24 hours?
Well, I would say one thing, and the president said this in his op-ed and then he repeated it today in Jerusalem, is the fact that he is no longer saying he's going to meet with King Salman. He's saying he's meeting with Saudi leaders, he said in his op-ed, and then today he said Saudi leadership. So he's not exactly saying the words Crown Prince Mohammed bin Salman, but that is what everyone is going to watch. One, what is the physical interaction between these two? The president wasn't really going to be shaking hands on this trip because of COVID precautions. He did so in Israel, so will he shake Mohammed bin Salman's hand? It's a big deal considering when he was campaigning for the office, he had vowed and said that he would like to make the kingdom a pariah, that the current government, which we know every day is led by the Crown Prince, Prince Mohammed, that had no redeeming qualities. And then the second, of course, is he needs the kingdom now. This about-face is dealing with the fact that he needs a foreign policy change because of domestic issue at home. Poll after poll, and we saw it yesterday in the data, inflation topping 9%. So much of that has been driven by the price of gasoline. So this is what all eyes are going to be on when he heads off to Jeddah tomorrow. And we should note he'll be the first president to ever fly directly from Israel to Saudi Arabia.
History being made. Anne-Marie Hordern, thank you very much indeed. Let's turn from what is happening in the Middle East to what is happening here in London. The ongoing contest to replace Boris Johnson. Rishi Sunak and Penny Mordaunt now cementing their lead in the race to become the Conservative Party leader and, by extension, the next UK Prime Minister. With us now, our UK government reporter, Joe Mays. Joe, we've now had two rounds of voting. How does today's vote in particular start to accelerate the process towards what increasingly looks like a Mordaunt-Sunak battle?
Well, as you say, it shows that Rishi Sunak is the frontrunner in this contest, with Mordaunt currently in second. And the key question now is going to be, how does the support reallocate itself from Suella Braverman, who's just been knocked out? She had 27 votes. Where will they go? Will they go to Liz Truss, who's currently sitting in third, such that it could push her into the final two? And then as further candidates get knocked out, it's all about that reallocation of support and who can make it into that final runoff when it goes to the Conservative Party members.
Joe, TD Securities came out after these results and said that they think the 2023 election is their base case and that Labour could actually win. What do you think about that?
Well, it would be for the Conservative Party to call an election in 2023. It doesn't have to happen until January 2025, but it could be the case that public opinion is overwhelmingly in favour of a general election, but the Tories still have the power here to call it. So I would caution about the idea of there being an early general election. It's not the case that when you have a new Prime Minister elected in this way that they have to go to the country. They might want to establish their own personal mandate, but the Tories are lagging Labour in the polls at the moment. So maybe there'll be a honeymoon period for the new leader and they see a lead and think, okay, now I'll go to the country. But don't take it for granted that would happen.
Joe, thank you very much indeed for the update. We'll continue to watch what happens next. It's interesting to see what is being debated amongst parliamentarians, what is going to be debated ultimately as the key factors when it comes to the Conservative Party and the country more broadly. OK, coming up on the European close, we're going to turn our attention back to what is happening with European politics and European economics. Paolo Gentiloni, the EU Economy Commissioner, is going to join us. We had the summer forecasts from the Commission a little bit earlier on. You've also got this added wrinkle factor for consideration. What is happening, Alix, with the Italian political scene, which is breaking down? We understand that Prime Minister Mario Draghi has gone to see the President Mattarella. Are we going to see a resignation? And how could that upend the European story? It's going to be interesting. Euro-dollar firmly below 1 at the moment.
Yeah, and you're definitely seeing the reaction within the markets. I mean, you see the Italian equities off by over 3%, almost 4%. You see a huge move in Italian bond yields, and that puts the pressure even more on the ECB. Are they going to be dealing with price stability and then now potentially a political crisis in Italy all at the same time and a potential energy crisis? I don't know how you do all of those three things.
Huge challenge for the ECB, of course. Spread widening, is it justified? Is it not justified? I think that's a really big issue for the ECB to handle next week. Anyway, Paolo Gentiloni is coming up, the EU Economy Commissioner. Looking forward to that conversation. This is Bloomberg.